In Chapter 10, we look at cost management and different ways that managers can view the costing of a product in order to improve it. What can we determine from our processes that can improve not only the end cost but the profit as well? This chapter is a lot of definitions, just giving you kind of a foundation to build on and knowing what kind of costs we're looking at and different ways we can improve the process. There are two main concepts I want you to get out of this chapter. We'll go through examples of each of those. One of them uses ABC costing and applies it to our income statements so that we can determine where our costs are really going to. And another concept is just looking at kind of our waste and how can we improve that process and the true cost of buying a product, including some of the waste or quality issues a manager might encounter. So there's two equations that don't jump right out at you in this chapter. One of them is talking about resources used. Your resources used is your cost driver. This is obviously in reference to that ABC costing. It's your cost driver rate, and you're going to multiply that by your cost driver volume. The next one is talking about unused resource capacity. So given how much we have supplied for this project or product, how much have we used, how much has gone unused. So this equation is taking your resources supplied and we're going to subtract out our resources used. So it's basically just telling us how much resources did we put into this job versus how much should we really have used. So again, some of these concepts are a lot easier to kind of grasp when you're working through an example. So we're going to go through an example of these. These are in your book. You can follow along and then you can try those examples in the homework example problems just to make sure you have an understanding of it. So this first example we're going to go through is example or exercise 10-36 in your book, and it's going to look at if we have some late deliveries, how much is this really costing us to purchase this product. So they buy electronic components and they have two different manufacturers. If the components are delivered late, the shipment to the customer is delayed, which ends up costing us some money. So it shows us some key pieces of information and also gives us some additional information that we might not need. But the point is that you pull out that information that you need. So it says the accounting department recorded $496 as the cost of late deliveries to customers. So therefore, we're going to take some of these numbers and look at what is the effective cost per carton. That means what is it really costing us to send these out? So right now our average cost is $20 from this Milan and $22 from Dundee. But considering that Milan has 25% of their deliveries are late, obviously a significant portion of that $496,000 is being attributable to this Milan customer. So let's look at that actual price and how we get there. So the first thing we're going to do is figure out how many cartons are delivered late. So to do that, again, first thing we want to do is how many cartons are late. Because they're giving us a percentage, so we need to take that 100,000 from Milan. They say 25% of that is late. And then we also have this Dundee customer. They have 60,000 total cartons that they purchase from them, and 10% of them are late. So if I do that math, that means a total of 31,000 cartons are late. Now, what we want to do is determine a cost per carton, cost of the late delivery per carton. Because now we know that we have 31,000 cartons that are late. We know the price of those late deliveries are $496,000. We know we have 31,000 cartons that relates to. Therefore, it's costing $16 per carton for each of these late cartons. So now what I want to do is compute the effective price of that carton, now that we have this additional information. So what is the effective price of each of these cartons? The Milan is only costing us $20 right now. So let's look at that one first. So Milan has 25% of their cartons late. So they're taking 25% of the $16 per carton, which is $4 per carton, that we need to add to that price. Our original price is $20. Therefore, our effective price is $24 per carton. And let's look at then the Dundee piece. Dundee's late deliveries are 10%. That price per carton that we determined was $16. Therefore, it's effectively adding $1.60 per carton to each of those. They're currently charging, $22 per carton. Therefore, my effective price is $23.60. When we look at this kind of data, we can see that even though Milan had a cheaper price to begin with, in actuality, it's better to go with Dundee because the effective price is lower. Now, the second part of this question is asking us, at what point would it not make a difference? What percentage of late deliveries would this Milan have to make to have there be no difference between prices? And basically all that is saying is, what's the break-even point? If we want our, what is our break-even point at the percentage of deliveries late that would create these two to be equal? To figure that out, we know that Milan is $20. So we want to know, how can Milan and Dundee be equal? We know that our price that we're adding on is $16 times the percentage of late deliveries. And we want it to equal Dundee. So we do a little bit of algebra here, and you can solve for P, and P gives us a percentage of 22.5%. So if Milan can improve the percentage of late deliveries to 22.5%, then there'd be no difference between these two. So it's just something to consider for managers, that even though you're getting a cheaper price, that might not always actually be costing you less. The other concept that I want to go through with you is an activity-based costing income statement. Again, we use this to kind of really break down our costs even more, just like we had done in other chapters. But here we're going to kind of input it into our income statement and convert it into resources used versus unused resource capacity, looking at how we can be more efficient. So given this data, simply put, they want you to just do that regular old income statement. We want to see what our costs look like. So we're just going to take our sales. We're going to list out our costs. We have setup cost. We have clerical cost. We would subtract those to get us our operating profit. So our sales are given. Those are $240,000. Our setup costs given. Those are $135,000. Clerical costs were $60,000, giving us a total of $195,000, leaving us an operating profit of $45,000. But unfortunately, this doesn't tell us that much. But if I come down here and turn it into an activity-based income statement, we're still going to have the same sales. We're still going to have the same operating profit. That's not going to change. But what we're really going to do is just break down those costs in a different way so we can see how we're spending our money. So first, let's input our sales. Again, it doesn't change. Now what we want to do is break down those costs. We have a couple of separate things we're going to look at. Some costs. We'll label these out separately. We have those clerical costs. We'll list out the setups first, since I did that the same way earlier. We have the clerical, giving us our total costs and our operating profit. Now remember, our resources supplied are going to be exactly the same as what's here, what's given. This is the same. This is what was given into the job, what was sent over there. So our setups should be $135,000 and our clerical should be $60,000, giving us a total cost of $195,000. The part that we have to calculate is those resources used. Remember, we gave you that calculation all the way up here at the top. We're taking the cost driver rate times the cost driver volume. So if I come down here, we're looking at setups. Our cost driver rate is $375. Our volume is $350. And that's the cost that I'm going to assign to setups. So the setups resources used should be 131 250. Again, this is the 375 times the 350. Now I just want to subtract these two to determine what is my unused resource capacity, which is 3750. So I'm taking my resources supplied and subtracting those used. I'm going to do the same thing for the clerical. The clerical, I have to scroll back up. That's based on 45 per page, and 1,000 pages is my volume. So I just take that 45 times by 1,000, and I would get 45,000. Again, I'm going to subtract and get 15,000 there. Now I can come down, find those total costs. 176,250 versus 18,750. You'll notice everything adds up to those resources supplied. Our grand total of costs are not changing. Our operating profit is not changing. But now we have a better idea of how we're using our resources. Hopefully that helps. There's not a lot of homework for this chapter. If you have questions on it though, please let me know.